Welcome back to FreightWaves Now this Tuesday morning. It's a battle of the mics here on...
Oh, is it?
It is. It is. Are you ready to fight to the death?
Who's the other Mike?
Mike Baudendistel. He's our intermodal expert, host of the Stockout, writer of the Stockout newsletter as well. He's here talking to us a little bit about CPG and what our grocery retailers are telling us about the state of the market.
As long as it's not like a battle of intelligence, I'll go for it.
Good to see you guys.
Good morning, Mike. Thanks for joining us today. So talk to us a little bit about what's going on. You put a pretty good pun in there. Grocers results a mixed bag for CPG companies. What does that mean?
So, taking a look at the CPG companies, anytime you look at an industry, you want to look at what their suppliers are saying, what their customers are saying, and, took a look at Kroger's latest earnings results. It caught my attention. It was up about 5% last week and Thursday when they reported earnings, and wanted to see if there were any, big takeaways for CPG companies, and, found a few here. That I wrote up this morning for the newsletter. The company is expecting, same-store sales to decline between 2.5% and 4% for this year. Kroger is, and actually thought that was better than a lot of people were expecting. That's probably why the stock was up. Grocery sales seem to be holding up better. I mean, when you compare it to what was happening a year ago, where there was just a buying binge of grocery items, you would have expected it maybe be down a little bit more than that, particularly with, restaurant, reservations, picking up. I saw that, Open Table, their reservations are now 90% of pre-pandemic levels. So people are getting out there. But some of the interesting sort of takeaways also were that's the higher, more expensive grocery items, those are selling really well, which is a benefit for most CPG companies. They tend to be priced ahead of private label brands or sort of more generic brands. And then consumers are really buying lots of fresh products, things to help them, get healthy, get back into shape after maybe being a little bit too sedentary and eating too many salty snacks over the past year. So those things are selling really well. So the CPG companies that are in those spaces, I think that was good news. I mean, if there is a sort of a negative here, is that Kroger's private label brands, they are doing very well also. So it is a very intense battleground between private label and CPG, but it does seem to be breaking down with healthy products doing very well and the premium products doing very well.
Everyone's trying to lose that COVID-19.
I was going to say the COVID-19. Yeah, that's crazy. So, what is going on? We figured that it would go down, but you've got, like you said, Open Table is saying that their reservations are at 90%. So things are picking up in that space as well. That doesn't drive anything into CPG, does it? I mean, that is more industrial, right? That has nothing to do with the CPG and what is going on there. So what do you attribute this positive to? I think it was what down 2.4%, which at Kroger, I think it was. Is that what you said, Michael?
Yeah. So they're for the full year, their expectation is their sales will be down between 2.5% and down 4% against a very difficult comparison versus the previous year. In this past quarter, their same store sales were down 4%. So those are shallower declines than people are expecting, and those reservations at restaurants that takes away from CPG sales. But I think is what's happening is people are buying fewer items, but they are buying more expensive items,
Gotcha.
and I think there's a positive mix there.
Is there any little bit of inflationary pressure that's kind of contributing to that more spend but less, I guess, haul that's going on with those consumers?
Yeah, that's certainly playing a role. And then I'd say an interesting thing that they said, Kroger said on its analyst call is that their inflation currently is only 1% to 2%, which really surprised me because the CPG companies have been talking about inflation, in their businesses in sort of the mid to high single digits. In a lot of cases, raising prices 4, 5, 6%, but not fully, making up the difference with the rising prices. So certainly, the average, the same, items are more expensive than they were, a year ago. And then also an interesting thing there was that Kroger said that it tends to perform best when its inflation is in the 3 to 4% range. They said if you go sort of above that, consumers really take a look at things and start to change their buying behavior. But sort of 3 or 4% is still okay, which maybe explains some of the behavior of CPG companies not wanting to raise prices more than a mid-single digit increase, even if their costs are rising faster than that.
Yeah, that makes sense. They want the rising tide to keep going. That all makes sense. What's on the horizon there, Michael?
Well, I'm gonna look a little bit more at some of the digital trends in CPG industry, and I think one of the things that's interesting is the retailers. Not only are they selling a lot of goods online, but they're also selling a lot of advertising online, and this is sort of a brand new revenue stream for retailers. Is they get the customers to go to the website. Let's say you go to Kroger.com or Walmart.com. Your intent is to buy a bunch of groceries. That's very valuable advertising space. Not only selling advertising space and landing pages, but they know who those individual consumers are and what their past buying behavior are. So they know if those consumers typically buy baby products or buy pet food or those things. So that's becoming a significant source of revenue for these retailers. So I'm going to dig more into that.
Awesome, Mike. Thank you so much for joining us this morning. Go watch the Stockout on Friday afternoons at 3 p.m. Go check out his newsletter up on FreightWaves.com.